think it's unlikely that interest rates will return to levels that were previously, the US Treasury Secretary said. A year ago, such an option was present in the White House forecasts. The inflation data released on Tuesday suggested that the Federal Reserve will keep elevated interest rates for longer than expected. Janet Yellen said the market should revise forecasts for the official funds rate in tune with the current macroeconomic situation. Let's look at exactly what realities are emerging now in the American economy and the Federal Reserve's monetary policy. Consumer price reports released on Tuesday defined forecasts. The CPI and the core CPI surpassed flash estimates at a minor degree. Both of them were an uptick higher. Nevertheless, it was enough to reassess the situation and the prospects for a cut in interest rates in the United States. Markets now fear that inflation may rage longer than anticipated, and this will require a more hawkish approach from the American regulator. The rate-setting committee is holding a policy meeting next week. The Federal Reserve is likely to reduce the number of rate cuts to 2 and postpone the first one until September. In other words, the inflation reports essentially highlighted sticky inflation and acted as a bullish argument for the US dollar. But since a lot of economic data should be absorbed, forex traders need time to put a clear picture out of these new items. Perhaps new data on factory inflation and retail sales in the United States have clarified this picture. Meanwhile, the US dollar index ended its correction in the range between 102.64 and 102.93 and went up. The final demand producer price index in the United States rose by 0.6% in February. The PPI was the highest since August last year and was twice as much as expected. Factory inflation also accelerated from 0.9% in January to 1.6% in annual terms. Retail sales grew by 0.6% in February from a month ago. At the same time, the consensus had suggested growth of 0.8%. In addition, the previous data was downgraded that consumer spending seems to lose steam. However, the US dollar remained in the bullish zone. The thing is that retail sales accelerated to 1.5% on a year, much stronger than the estimated 1% growth. Importantly, consumer activity is the main catalyst for the economic growth in the United States. In this context, robust retail sales deny the signs of a recession in the United States. Meanwhile, stocks on Wall Street are losing their positive mood amid the firm US dollar. At least since yesterday, the S&P 500 index has no longer been eager to storm new records. Today, it was trading in a narrow sideways range between 5,150 and 5,179 points, while major currency pairs are trading in narrow ranges. The yen remains under the spotlight. Remarkably, the Bank of Japan will announce its long-awaited hawkish policy decision on March 19. That's a day earlier than the US Federal Reserve will bring its verdict. Considering that the American regulator is almost certain to make no changes to its settings, a unique situation may arise in the forex market. The yen is already holding the upper hand over its rivals, the dollar and the euro. As for the single European currency, its position today is largely determined by the comments of the ECB policymakers. On a Monday, François Villeroy de Gallo suggested that the first rate cut would take place in April. However, according to ECB President Christine Lagarde, the optional date for revising the refinancing rate may be June. The same point of view was expressed on Wednesday by the governor of the Bank of Austria, Robert Holzmann. On Thursday, the markets are digesting two opposing comments. ECB chief economist Philip Lane noted that there is no need to rush into the transition to new settings. In contrast, one of the governors of the ECB Governing Council, Yellen, advocated for the idea of an early rate cut. At the same time, he admitted that the process of a monetary easing could begin in the Eurozone earlier than in the United States. The viewpoints of the speakers were diverged between spring and summer. At the same time, they are ready to show flexibility to effectively solve economic problems. In any case, both of these dates for the first rate cut are bearish for the euro. In addition, the single currency reacts pessimistically to the weak performance of the German economy, which is going through troubled times, and this situation looks even more dismal compared to reports confirming the stability of the US economy and the US dollar. During the month, the euro-dollar pair followed a steady uptrend. Now it seems that the trajectory has changed to the opposite. As a result, the euro faded to climb to 1.10 against the US dollar, and now it seemed to be stuck firmly in the bearish zone. In the early hours of the New York session, the instrument was trading at the lower border of the corridor between 1.0915 and 1.0950. The euro is about to break the support of 1.0910 and is ready to test the low of March 12. Lower levels are ahead. If the dollar bulls might show hesitation while waiting for a statement from the US Central Bank, the balance of the trading forces will remain in the same. So the US dollar's advance will ultimately be of a rather symbolic nature. Since yesterday evening, oil prices have been trading firmly higher. While the currency market has come to a standstill, the oil market has perked up. In the meantime, oil prices have been rallying. During intense growth, futures for the benchmark BRENT have already increased in value by more than 2.5%. The rally is underpinned by data from the American Petroleum Institute. US crude inventories shrank by only 1.5 million barrels last week. Gasoline reserves slumped by 5.7 million barrels. In turn, this could entail local deficits and surge in inflation. Sparse supply boosts demand and pushes the price up. This is reflected in the Brent oil chart. If today's reports confirm the fact of a huge decline in crude and gasoline stocks in the United States, then prices will predictably continue to rise. But in short term, the sharp price change resulted in a technical overbought signal. It looks like OPEK and the United States are trying to outplay each other. Who will give up first? Will it be the United States due to a strong decline in its reserves? Or will OPEK and its allies be forced to cut production for longer and more? Meanwhile, oil prices may enter a broad uptrend. You have watched the market review by InstaForex analyst for Thursday, March 14. Subscribe to InstaTraders TV channel and we keep you updated on all market developments. Don't miss our videos. Your feedback is appreciated. See you online tomorrow.